After studying this module, you shall be able to understand of financial statement analysis, objectives of financial analysis, horizontal financial analysis, vertical financial analysis, meaning of trend analysis, and practical knowledge about vertical and horizontal analysis. Financial statement analysis is an analysis which accentuates significant rapport in the financial statement. Financial statement analysis embraces the method used in assessing and interpreting the result of past performance and current financial position as they relate to particular factors of interest in investment decisions. It is a significant way of evaluating past performance and in forecasting and planning future performance. Financial statement analysis is an information processing system fabricated to furnish data for decision making models such as portfolio selection model, bank lending decision models, and corporate financial management models. Now we begin our discussion by understanding the meaning and nature of financial statement analysis. Financial statement analysis is a significant part of overall financial analysis based on these financial statement end products of accounting system, namely balance sheet and profit and loss account. They are prepared for analyzing the financial statements. Analysis of financial statement is a meticulous process of critical examination the financial information engulfed in the financial statement in order to comprehend and frame decisions regarding the operations in the firm. The analysis of financial statement is the study of relationships among various financial facts and figures as set out in financial statement, that is balance sheet and profit and loss account. The complex data given in these financial statements is divided or broken into simple and valuable elements, and relationships are established between elements of the same statement or different financial statements. Financial statements indicate certain absolute information about assets, liabilities, equity, revenue, expenses, and profit or loss of the enterprise. They are not readily understandable to the extent users of financial statements. A financial analyst can adopt the following tools and techniques for analysis of the financial statements. Comparative financial statements are the statements in which depict the amount for two or more periods are placed side by side, along with change in figures in absolute and percentage terms to facilitate comparisons. Both profit and loss account and balance sheet are prepared in the form of comparative financial statements. Financial statement analysis gives structural relationship of the various items in the financial statements. The main functions which are used in the process of analysis and interpretation are: first, rearrangement of financial statements. For analysis, it is necessary to reclassify the data contained in the financial statements into purposive classes so that maximum information from varied data for analysis can be obtained. Reclassification and rearrangement of different data depend upon the purpose of analysis. Second, comparison. After the classification of data of financial statements into different categories, it is necessary to derive comparative data of the same enterprise of the past periods, if it is a time series analysis. In case of cross-sectional analysis, it is necessary to derive comparative data of the same accounting period of similar of comparable enterprises. For this, a comparative study is necessary. Third, analysis. Comparative financial data are then analyzed with reference to financial characteristics like profitability, solvency, and liquidity. Fourth, interpretation. The concluding part of financial statement analysis is interpretation of financial information generated in the process of financial statement analysis. The interpretation should be precise and directed towards indicating the movement of various financial characteristics. Now we discuss the objectives of a financial statement analysis. The financial statement analysis helps in evaluating the real meaning and significance of financial data as disclosed in the financial statement, calculating the liquidity and short-term solvency position of the enterprise, assessing the long-term solvency position of the enterprise, evaluating the present and future profitability of the enterprise, evaluating the operational efficiency of the enterprise, evaluating the managerial efficiency of the enterprise, assessing the growth potentiality of the enterprise, evaluating the different activities of the concern, and assessing the financial stability of the enterprise. Now we move further to discuss the concept of horizontal analysis. Horizontal analysis is a financial statement analysis technique that shows changes in the amounts of corresponding financial statement items over a period of time. Horizontal analysis of financial statements involve comparison of financial ratio, a benchmark, or a line item over a number of accounting periods. This method of analysis is also known as trend analysis. Horizontal analysis allows the assessment of relative changes in different items over time. It also indicates the behavior of revenues, expenses, and other line items of financial statements over the course of time. Horizontal analysis of financial statements can be performed on any of the item in the income statement, balance sheet, and statement of cash flows. The statements for 2 or more periods are used in horizontal analysis. The earliest period is usually used as the base period, and the items on the statement for all later periods are compared with items on the statements of the base period. The changes are generally shown both in amount of percentages. Now we show this with the help of a formula for amount and percentage changes as computed by using the following formula. First, for amount change, amount of the item in comparison year minus amount of the item in base year. Now we have second, for percentage change. This is equal to amount change divided by amount of the item in base year multiplied by 100. Horizontal analysis may be conducted for balance sheet, income statement, schedules of current and fixed assets, and statement of retained earnings. Now we are going to understand the concept of vertical analysis. Vertical analysis of financial statement is a technique in which the relationship between items in the same financial statement is identified by expressing all amounts as a percentage total amount. The financial statements prepared using this technique are known as common size financial statements. The main advantage of using vertical analysis of financial statement is that income statements and balance sheets of companies of different sizes can be compared. Usually the vertical analysis is performed for a single accounting period to see the relative proportions of different account balances. It is also helpful to perform vertical analysis over a number of periods to identify changes in accounts over time. It can help to identify unusual changes in the behavior of accounts. This analysis is performed on the income statement as well as balance sheet. Balance sheet. When applying this method on the balance sheet, all the three major categories accounts, namely assets, liabilities, and equity, they are compared with the total cost. All of the balance sheet items are presented as a proportion of the total assets. These percentages are shown along with the absolute currency amounts. For example, suppose a company has three assets: cash worth $4 million, inventory worth $7 million and fixed assets worth $9 million. The vertical analysis method will show these as cash 20%, inventories 35%, fixed assets 45%. Now we come to income statement. And when applying this technique to the income statement, each of the expenses compared to the total sales revenue. The expenses are presented as a proportion of total sales revenue along with the absolute amounts. For example, if the sales revenue of a company is $10 million and the cost of sales is $6 million, the cost of sales will be reported as 60% of the sales revenue. Now we present a comparative balance sheet with vertical analysis having the assets of 10 lakh comprised of fixed assets with 6 lakh, that is 60% of total, investments 10 lakh with 10% of total, and current assets 3 lakh as 30% of the total assets. Liabilities total of 10 lakh comprising of equity share capital and preference share capital worth of 4 lakh having 40% to the total liabilities. Reserves and surpluses 1 lakh to the tune of 10% of the total liabilities. Secured loan 1 lakh to the 10% of the total liabilities. Secured loans 2 lakh to the 20% of the total liabilities. Unsecured loans 1 lakh to the tune of 10% of the total liabilities. Current liabilities 80,000 to the tune of 8% of the total liabilities. And provisions are 20,000 to the tune of 2% of the total liabilities. Then we have income statement for the years ended December 31st, 2014, having net sales 4,15,000. From this we deduct cost of goods sold to the tune of 2,90,000, that is 69.9% of the total percentage. We get gross profit of 1,25,000, that is 30.1% of the total. From this we deduct selling expenses of 39,500 to the tune of 9.5% of the total amount. Then we have administrative expenses 49,640 to the tune of 12% of the total amount. Then we have interest expenses of the amount 3,000, that is 0.7% of the total amount. And lastly we have income tax of 14,100 to the tune of 3.4% of the total amount, and after deducting from the gross profit we get net income of 18,760, that is 4.5% of the total amount. Now we further move to understand the meaning of trend analysis. Trend analysis can be done to observe percentage change over time in selected data. In trend analysis, percentage changes are evaluated for several successive years rather than between 2 years. Trend analysis has significance due to its long-run view. It may point to basic changes in the nature of the business. Observation of the trend helps one to find out whether the ratio is falling, rising, or remaining relatively constant. Trend analysis employs an index number over a period of time. Trend analysis helps you to comprehend the past performance of your business and also assist you in predicting where current business operations and practices will take you. Trend analysis is the process of comparing business data over time to identify any consistent results or trends. Now we show this with the help of annual performance in percentage of base year. We have the sales with 10 lakh with year first of 100%, year second 106%, year third 120%, year fourth 158% and year fifth 205%. Then we have net earnings having 2 lakh worth with 100% for first year, 107% for second year, 124% for third year, 141% for fourth year and 172% for fifth year. The trend percentages reveal that the growth in earning outstripped the growth in sales for years 2 and 3 and fell below the sales growth in the last 2 years. We explain this with the help of some of the problems. The first problem is we have given the summarized balance sheet of Green Limited and we have to prepare horizontal comparative balance sheet. We have been given liabilities comprising of equity share capital, preference share capital, reserves and surpluses, secured loans, unsecured loans, current liabilities and provision. The amounts for the respective for equity share capital for the year 2013 it is 60 lakh. For preference share capital it is 15 lakh. For reserves and surpluses it is 15 lakh. For secured loans it is 30 lakh. For unsecured loan it is 15 lakh. For current liabilities it is 12 lakh. And for provisions it is 3 lakh. The respective figures for 2014 are for equity share capital it is 60 lakh. For preference share capital it is 15 lakh. For reserves and surpluses it is 18 lakh. For secured loans it is 27 lakh. For unsecured loans it is 18 lakh. For current liabilities it is 13 lakh 20,000 and for provisions it is 3 lakh 30,000. The total liabilities for the year 2013 comes to 1 crore 50 lakh and for 2014 it is 1 crore 54 lakh 50,000. Now we come to assets that comprise of fixed assets, investment and current assets. The fixed assets for the year 2013 comprises of 90 lakh, investments 15 lakh and current assets 45 lakh. For 2014, we have fixed assets 1 crore 8 lakh, investments for the year 2014 15 lakh and current assets are 31 lakh 50,000. The total assets comes to for 2013 1 crore 50 lakh and total assets for the year 2014 comes to 1 crore 54 lakh 50,000. Now we start the solution of this problem. We have 2 years 2013 and 2014 and we have the fixed assets, investments and current assets for these 2 years. We have fixed assets for 2013 that is 90 lakh and for 2014 we have 1 crore 8 lakh. This shows that the fixed assets have increased by 18 lakh, registering a percentage change of 20%. Then we have investment in the year 2013 of 15 lakh and in the year 2014 we have 15 lakh. That is, there is no change in the investments. Then we have current assets for the year 2013 that is 45 lakh and for the year 2014 we have 31 lakh 50,000. That means there is decrease in current assets by 13 lakh 50,000. In percentage terms it comes to 30% of the total. That means we have the total assets for the year 2013 with 1 crore 50 lakh and for the year 2014 we have 1 crore 54 lakh 50,000, registering an increase of 4 lakh 50,000 with a percentage of 3% increase in total assets. Then we have equity share capital for the year 2013, namely 60 lakh and 60 lakh, that is no change for equity share capital. Then we have preference share capital for 2013, we have 15 lakh, and for 2014 we have 15 lakh. That is, there is no change in the share capital of equity as well as preference share capital. Then we have reserves and surpluses. The reserves and surpluses for the year 2013 are 15 lakh. They have gone to 18 lakh. That is, there is an increase of 3 lakh, showing an increase of 20%. Then we have secured loans. They have reduced from 30 lakh in the year 2013 to 27 lakh in the year 2014 by 3 lakh, showing a decrease by 10% of the total. Then we have unsecured loans. They have increased from 15 lakh to 18 lakh in the respective years of 2013 and 2014 by 3 lakh, showing in terms of percentage by 10% of the total percentage. Then we have current liabilities. They have increased from 12 lakh to 13 lakh 20,000, showing an increase of 1 lakh 20,000 over the 2 years, namely 2013 and 2014, with a percentage increase of 10%. Then we have provisions. They have also gone up from 3 lakh in 2013 to 3 lakh 30,000 in the year 2014, showing an increase of 30,000 with a percentage of 10% of the total. That means the liabilities are total of 2013 for 1 crore 50 lakh, and for 2014 they are 1 crore 54 lakh 50,000, showing an increase of 4 lakh 50,000, that is by 3% of the total. Now we take another problem to prepare the vertical common size statement from the following information. We have fixed assets, investments and current assets as 6 lakh for fixed assets, and investments 1 lakh, and current assets of 3 lakh, making a total of 10 lakh of assets. Then we have liabilities comprising of equity share capital 4 lakh, preference share capital 1 lakh, reserves and surpluses 1 lakh, secured loan 2 lakh, unsecured loans 1 lakh, current liabilities 80,000 and provisions are 20,000. That means we have total liabilities of 10 lakh. Now we make vertical analysis. That is, we start with assets. We have fixed assets of 6 lakh, that is 60% of the total. We have investments of 1 lakh, that is 10% of the total. We have current assets of 3 lakh, that is 30% of the total. And we have 10 lakh of assets. Then we have liabilities, that is equity share capital of 4 lakh, that is 40% of the total. Then we have preference share capital of 1 lakh with 10% of the total, reserves and surpluses of 1 lakh with 10% of the total, secured loans 2 lakh with 20% of the total, unsecured loans 1 lakh with 10% of the total, current liabilities 80,000 with 8% of the total, provisions 20,000 with 2% of the total, making a total liabilities of 10 lakh. Now we make a summary of what we have discussed so far. Financial statement analysis is an analysis which highlights important relationships in the financial statement. Financial statement analysis embraces the method used in assessing and interpreting the result of past performance and current financial position as they relate to particular factors of interest in investment decisions. Financial statement is a significant means for evaluating past performance and in forecasting and planning future performance. Financial statement analysis is a significant part of overall financial analysis balance sheet and profit and loss account based are the end products of accounting system which are based on these financial analysis. Horizontal analysis is a financial statement analysis technique that shows the changes in the amount of corresponding financial statement items over a given period of time. Horizontal analysis of financial statements engulfs comparing financial ratios or a benchmark or a line item over a number of accounting periods. Vertical analysis of financial statement is a technique in which the relationship between items in the same financial statement is identified by expressing all amounts as a percentage of total amount. The main advantage of using vertical analysis of financial statement is that income statements and balance sheet of companies of different sizes can be compared. Trend analysis of basic changes in the nature of the business and trend analysis uses as an index number over a period of time.